YouTube, it's your guy, not your average trucker, coming to you on a Sunday, uh, March the 1st. I had somebody hit me with an email that had an interesting question, and rather than just reply to him, I figured I could just post a video that might help, more people than just him. The question was in reference to he's an owner operator. He has two trucks, and he wants to buy a house, and he's having a hard time getting approved for a mortgage. He said his down payment is straight. He says he has, his credit score is like 750 or 800. Oh, he said one of the bureaus had him at about 800. But the problem that he's running into is that he can't get approved for a mortgage based on his income. Because, when you're an owner operator out here or you're a fleet owner out here, basically anybody that's self-employed, they have a hard time verifying their income because it's like a lot of your customers, in his case, brokers or whatever, they're paying them on 1099. And then, obviously, when you're a business owner, entrepreneur, when you're filing your taxes every year, you take as many deductions and credits and write-offs as possible to lower your tax liability. But in doing that, that also lowers your income pretty much. So you could have somebody like him who grosses maybe $400,000 a year, but once he's done writing off maintenance, fuel, various other expenses, his income might only be $20,000 or something. You understand? Which is good in terms of your tax bill, but it's terrible in terms of trying to get approved for a mortgage. Because when you're trying to get approved for a mortgage, they're looking at a few things. You understand? They're looking at your income and your ability to repay, right? So he clearly satisfies the ability to repay because with a good credit score, with good reserves in the bank, 3 to 6 months worth of reserves, he obviously has the down payment. The problem comes income because they're saying that his adjustable, his adjusted gross, well, basically his net is only about $25,000-$30,000, whereas he grossed about $400,000. So he was asking me, he's frustrated because he's making good money, and him and his wife, they want to upgrade and actually buy a home instead of renting. And he's like, yo, he's running into this dead end. And he was asking me, since I do real estate, if I knew anybody that could help him out. And on multiple levels, I do. There's a lot of alternative financing out here. It used to be really, really prevalent prior to, the mortgage crisis and all that, real estate crisis in 08, 09. But they have a lot of programs out here called non-QM loans. You understand? Which is basically loans that the alternative financing. I don't know what else to say it. See, back in the day, they used to have these things called stated income, which is what messed the market up because you had a lot of people out here with dead-end jobs only making about 30 grand a year. But with the stated income loans, if they wanted to get approved for a house, the mortgage broker would be like, hey, in order for you to get approved for this, you need to say that you make $200,000 a year, right? And so that's what they would do. They would say that they made $200,000 a year. Then they had all these down payment assistance programs to get you in that house with, basically less than 1% down. And, here you are, you in a house that you can't freaking afford. And once things go wrong, pretty much you out on the street. But with these non-QM loans, they're not like stated income loans because there are various levels of qualifying you. But what they do is they help people such as myself or such as you that are make plenty of money, but you're basically self-employed. So how do you prove your income? So they have multiple factors. The one that I'm hooking him up with, I know a guy, he does a lot of what's called bank statement mortgages. Difference between a bank statement mortgage and your standard mortgage is your standard mortgage is going to use your W-2 and your pay stubs to verify your income. Whereas a bank statement mortgage, they're going to use 12 to 24 months of your bank statements to qualify you. So say you're an entrepreneur, you're trucker like him, and he's he's getting constant deposits from his brokers and his customers, constant deposits. So every month he might have $25,000, $30,000 in deposits. What they'll do, as long as if it's a personal account, they use 100% of your income. So if you're getting $25,000 deposited in there every month, they're going to use that $25,000 multiplied by 12, and that's your yearly income. If it's a business account and you can prove that you own at least 50% of the business, they're going to take 50% of the deposits. So if you're getting $25,000 a month worth of deposits, they're going to take what, $12,500 a month, multiply that by 12, and that's your income. The good thing about these is you don't have to show any. Only paperwork you have to show for these types of loans is proof that you own the business or your percentage of ownership and your freaking bank statements. That's it. Whereas with a standard mortgage, you showing your bank statements, you're showing your W-2, you're showing your tax stubs. This is as close as you're going to get to a what they call no doc loan. This is as close as you're going to get. You're just showing them proof of ownership and bank statements. And what that's going to do is, if you're in business, you're getting all these deposits, it's going to qualify you for more house. You understand? So if you're in a situation where you self-employed or you paid on a 1099, I mean, it's a lot of y'all that are just working for somebody that's paying you on the 1099. You're not even an owner-operator, and you're having a hard time getting qualified based off that. You would go for a non-QM loan. Only difference is if a standard mortgage or a fixed mortgage is, say the interest rate is 4% or whatever, a freaking non-QM loan might be, depending on your credit, 0.5% more. So if the going rate right now for a FHA loan is 4%, non-QM loan, you would qualify for about 4.5% or 4.6%. So, but another benefit of it is if you're not putting 20% down, with a conventional mortgage, you're going to have what's called mortgage insurance, which could be another $300-$400 a month. But with these non-QM loans, you're going to have to put 10% down, at least 5 to 10%, I believe. But they don't have any mortgage insurance. So overall, you're probably saving that interest rate. If you're able to get the lower end of the interest rate on a non-QM, you're probably saving versus somebody that has a FHA loan, but they didn't put as much down, so that, until they reach that 20%, they're going to be paying mortgage insurance or until they refinance out of it. So, but anyway, to answer my man's question, I know this video won't apply to a lot of people, but to answer your question, my man, if you out here, you self-employed, owner, operator, whatever, you could be somebody that's not even in trucking, that's just watching my video, but you self-employed or you getting paid on a 1099 and you're having a problem finding getting approved for a regular mortgage, hit me up, man. I could email you some contacts that I have that's all they do is non-QM loans and freaking bank statement mortgages and things of that nature. But it's your guy, Not Your Average Trucker, coming to you on a Sunday down in my man cave. Shout out to my Charlotte Hornets and my where you at? My Panther back there down in my man cave. Y'all be easy, you heard?